If you receive more than $600 from payment applications like Venmo, Cash App, Apple Pay, Google Pay, and PayPal, you may be subject to additional taxes when you file your tax returns due to new IRS rules, even if the payments are from friends, family, or other connections. If you are not careful, you may be subject to additional tax because payment applications like these are now required to report your payment activity to the federal government. And more than 20 million taxpayers will be affected by these new tax changes. So as a licensed CPA that tax plans every day at mycpacoach.com, I want to help you plan for these new rules and, more importantly, help you keep more of your hard-earned money. So let's jump in. Okay, so basically the IRS is cracking down on people and businesses who do not report income they receive through third-party payment applications like Cash App and Venmo, for example. For instance, it is very common for professionals like freelancers, cleaners, handyman, plumbers, babysitters, barbers, hairstylists, and so on to accept payments through a platform like Apple Pay, Venmo, or PayPal. But then on top of that, there's other people who may receive payments on these platforms from friends or family as a gift, or maybe as consideration for helping them out with a project. Maybe you have a friend that is helping you move to a new place and they're paying you, or whatever the case may be. Now, in many cases, both professionals and ordinary people who receive these types of payments do not properly report these payments as income when they file their tax returns, if they report it at all. And when people do not report these payments as income, Uncle Sam has a problem with it because Uncle Sam cannot collect taxes on payments that are not reported. So as these platforms continue to rise in popularity and usage, the potential for taxpayers to underreport their income has become a bigger issue for the IRS, leading them to adopting new rules for reporting from payment applications. The IRS has just released a notice that states that third-party settlement organizations are now required to report transactions for goods and services that exceed a specific threshold. And here are the thresholds for the upcoming tax years. In 2024, these platforms will be required to file a report to the IRS about your account if you receive payments that exceed $5,000 in 2024, $2,500 in 2025, and $600 in 2026, and every year thereafter. So if you have already or expect to receive income in excess of these amounts through any payment platform, your payment provider will be filing a report to the IRS about your payment activity. And this is what it's going to look like. Your payment provider will issue a 1099-K that lists your name, your address, your tax identification number, and the gross amount of activity through your account. You will receive a copy of this form, and the IRS will receive a copy of it as well. And since the IRS already has a copy of this, this means that they will be able to easily detect if you file your tax return without properly reporting your income from these types of payment applications, because now they have a record of it. So now if you fail to properly report your income, it may automatically trigger a tax return error in their system and lead to further notices, penalties, interest, fines, and even a full-blown audit. For example, let's say in 2025, you sold some furniture and equipment for $2,700 through Apple Pay. And when you went to file your tax return, you forgot to include this payment as income. Well, in this case, the IRS would already know about this transaction because Apple would have filed a 1099-K to them that reports the income that you receive through their platform. So when you file your tax return without reporting the income, the IRS system would now likely pick up the underreported income on your tax return immediately, which could cause a number of issues from a compliance standpoint. It would almost be like filing your tax return without including your W-2. Obviously, the IRS is going to see that, and the only difference here is that instead of your employer filing a W-2 with the IRS, which they do, the third-party payment applications would now be filing a 1099-K with the IRS. But there is one popular payment application that is not required to file Form 1099-K, and that is Zelle. Zelle is exempt from 1099-K reporting because it facilitates direct bank-to-bank transfers without holding funds during the transactions, and is also not a third-party settlement organization like the other applications we have discussed. Zelle specifically states on their website that it does not report transactions made on its network to the IRS, and that the law to provide 1099-K forms does not apply to it. However, they do reinforce the fact that it is your responsibility to report payments that are taxable to the IRS, which is not a new requirement. So even though platforms like Zelle are not subject to these requirements, you can still end up in trouble with the IRS if you fail to report any portion of your taxable income, regardless of how it was paid to you. But for many people, it is unclear which payments are considered taxable income and which payments you receive that are not. So let's break this down very quickly. So first of all, only income is taxed, which means that if you receive a payment that is not considered income, then it is not subject to income tax. And the IRS defines income as all money that a taxpayer receives that is not explicitly exempt by the tax law. And specifically as it relates to this, gifts are not considered income and are not subject to income tax. Therefore, if a friend or family member sends a payment to you as a gift, then it should not trigger an income tax when you file your tax return. For example, the IRS specifically states that payments from friends or family as a gift or repayment for a personal expense should not be reported on Form 1099-K because it is not taxable income. So as you can see, this also applies to reimbursements. If you are receiving a reimbursement from someone for a personal expense, like an event ticket or something, then that payment would not be considered taxable income. So the payment application that you are using should not report this information to the IRS as well at all. But in order to do this, those payments should be marked as non-business payments once sent in those platforms. For example, when sending payments to someone through PayPal, it requires you to select whether or not this payment is for goods and services or for friends and family. So if you select friends and family, those payments should not be reported on your 1099-K or be subject to income tax for the person receiving it. However, if you are receiving payments in exchange for providing goods and services to anyone, even if they're your friends or family, then those payments would be included on your 1099-K and be subject to income tax. In any case, it will be very important that the payments you receive and send are categorized correctly to ensure proper reporting and that you don't pay more taxes than you actually have to. Or on top of that, you may prefer to use a platform like Zelle, which may provide you with more peace of mind and control over how your income is being reported to the IRS. But keep in mind that that does not change the rules on how your income should be reported in the first place. To stay in the loop on this, make sure you subscribe and be sure to drop a comment below to let me know what you think about this. And if you currently pay a lot of money in taxes to the IRS and want a plan that is guaranteed to reduce it, just go to mycpacoach.com to apply to work with one of my CPAs today.